Hello, everybody. My name is John Humphreys. I'm the Executive Director of the Wisconsin Association for Equity and Funding. And I'm here with Matt Silkey from PMA Securities, folks who help school districts invest for cash flow, as well as when they have earned them. And you can find Matt's introduction to cash flow analysis and investing on our YouTube channel, where we'll also be posting today's video. This is actually originally presented earlier today, but we had some technical difficulties and the session was not recorded. So Matt has very graciously agreed to record to start a presentation on the market update. We're sitting here just a little while after the Fed made one of the largest rate reductions in quite a long time. And Matt has some background on that. It's an interesting time to be looking at school district investing, Matt. And so thanks again for joining us. This is year three. So I really appreciate your continued views.
Yeah, thanks for having me again here, John. Yeah, 3 years, boy, it goes by real quick doing this every 6 months only. And one thing I didn't mention earlier today, and I'm happy to kind of just rebuff on it at some point, is the cash flows. Um, Generally, we recommend it as one of the greatest tools that a district can have in order just to, it's for administrative planning purposes for districts that need to short-term borrow. It's imperative, and for districts that have ample cash flow, they can actually utilize that to build off of some of these investment discussions that we're going to have here today. But we just came out with a new web-based cash flow, which does quite a bit more than what we were used to do for districts with the click of a button. And so, yeah, look for that. But yeah, thanks again for having me. Um, so I think what we were going to do today was start off with a bit of an economic outlook or an economic update. And I kind of want to just touch on a couple of things that aren't necessarily district specific in terms of importance, but they're just kind of just some things to look for this week. Number one, it's earnings season. And really what that means is that all of the publicly traded companies in the stock market are bringing forth their quarterly profits and losses. And so right now, I think that's a really good opportunity for us to kind of analyze where we're at in terms of how this first rate cut has impacted some companies, which is why it's kind of really important for us to kind of zero in a little bit on the bank earnings, is because these banks are going to be really more so affected by these interest rate cuts. So we kind of want to see how they've been coping with some of these lower interest rates. And so additionally, oil prices have been slumping over some concerns about Israel attacking Iranian energy facilities. And that's kind of dragging down some of the energy stocks right now. And we'll talk a little bit about that a little bit further down the discussion. But on the other side of the world, investor optimism in the United States is registered its biggest bump since the bottoming out during the pandemic in June of 2020. Allocations to stocks have soared. Bond exposure has been dropping, and cash levels fell to 3.9% from 4.2 in September. So a lot of people recognizing the downturn in fixed rate opportunities and recognizing that the markets are approaching all-time highs in many areas, including the Mag 7, Magnificent 7. Some companies that we've talked to is actually up 160% over the last 2 years. So that would be Apple, Microsoft, Alphabet, which is Google's parent company, Amazon, Nvidia, Meta, which is Facebook, and then Tesla's the most recent addition to that group, I believe. The S&P during that same period is up 60%, which I'm sure everybody that's watching this is very happy about with our 403Bs and 401Ks. It's actually set its 46th record high for the year. So stock markets are doing pretty great right now. And I know that provides a lot of excitement because it means really that all of these companies are kind of firing on all cylinders. But also, I think it's worth noting that we also kind of see it as a cautionary tale, just because market cycles do exist, and you always want to be cognizant of the downswing when the good times are in front of you. So now additional concerns, I think, are coming out of some of these big tech companies right now, just because the U.S. is discussing capping the sales of advanced AI chips. That's really more on like a country-to-country basis, but no telling yet just how that's going to affect some of these companies like NVIDIA. Um, but also, I'm sorry, and in that being said, I kind of wanted to also point to that if the S&P does end up hitting its targets for next year, um, it will hit a mark of 9% returns per year, which is a figure far above the norm of post World War II America of about 8.2%. And actually, that 8.2% has been sort of a benchmark that I've used in my entire career. So to know that that's now approaching 9 just because of most recent history is pretty remarkable. So, and lastly, this is just something that I think is um, it, it could be potentially of worth for some of these larger pools that we're going to be talking about, given that it's going to be corporate debt here. But Boeing, the airplane maker, could become the biggest U.S. corporate borrower in history to be stripped of its investment grade rating and cut to junk. Which would really open the floodgates for the high yield credit market in terms of record volumes of debt that needs to be absorbed. So um, I don't know where discussions are at right now, but I do know that there's open lawsuits coming out. So things could not be looking very good for Boeing, but just something I kind of wanted to bring up because obviously we're entering the holiday season, which is busy for travel and could affect the prices there. So um, of particular interest to those people on this call, however, are interest rates, borrowing and investment rates. On one side of that discussion, though, there's just simply not a strong correlation between Fed moves and the tax exempt borrowing market. It's modest, really, if anything. So some people feel as though, maybe the entire yield curve just sort of drops by 50 basis points when the Fed moves, and that's really just not the case. And so we're going to spend the balance of today's discussion talking about investment yields, and we're going to start with just a little bit about what we're forecasting, and we're going to shed a little bit of light on where the Fed is currently at and what some of the data that they use to support their decisions that they're making right now. And so what you see here is quarterly GDP, which is a very much a household term. It's really a measure of the value added or created through the production of goods or services. And you can see that going back into 2021, everybody was spending money. Money was being it was ample in the market. Inflation was just about to hit, and so you can see that people were really spending. And I want to say that this is largely a measure of the consumer spending, whereas CPI, which we'll look at here in a second, is going to be a measure of the cost of that spending. But I think they do go both hand in hand. So quarter four and then quarter one, 2, and 3 going into 2025. It's worth noting that those numbers are much more normalized versus where we've been in recent history, and I think that kind of speaks to supporting the Fed's decision that consumer spending is going down, and so cutting rates now is something that's appropriate. And so here's looking at CPI. The much awaited CPI report came out yesterday. And it left a lot of Federal Reserve officials really unfazed, kind of suggesting that they see the path of the central bank to keep cutting interest rates. And I did bring up energy earlier because you can kind of see here, like, later in the pandemic, energy prices were extremely high and really affecting the pocketbooks of Americans. But more recently, actually, energy has been sort of pulling those prices down because their prices have been dropping. And so the next thing I kind of want to point to here is that you see two numbers over here, and one of them is going to be CPI and one's core CPI. And core CPI is really kind of the leading indicator when it comes to talking about inflation because it really pulls out those volatile food and energy prices. So while we're seeing a lower CPI right now because of those food and energy prices kind of pulling that downward, that 3.3% still is just a little bit high, I think, for where the Fed wants it. But it's at a point where the Fed, I think, feels comfortable in dropping some of those yields. So there's a dual mandate that the Fed has in terms of why their job and why they exist. And one is to keep stable prices in the marketplace, and then one is to keep maximum employment. And so job gains slowed ahead of the September meeting, and the unemployment rate ticked a little bit higher, kind of catching the eye of the Feds in quarter 3, but unemployment really remained low, is still well below the 30-year average, really limiting the number of qualified candidates to fill open positions and heavily affecting the wage growth, which if added to the Fed's decision, like, hey, yep, I think 50 basis points is a good jumping off point, even though there were a couple members of the FOMC that one voted against the 50 basis point cut for 25, and there were a couple other ones that spoke up about it as well. And but it's just a very big point of discussion here. How much was where we wanted to begin cutting rates. And lastly, this actually isn't even really a data point that the Fed is dependent on. It's more a leading indicator, if you will, about where federal effective rates are going to go. And so this is the 2-year Treasury. It's highly sensitive because it's considered a key indicator of near-term market expectations regarding future Federal Reserve interest rate policy, meaning that any anticipated changes in Fed policy directly impact the price of this short-term bond, making it very volatile compared to the longer-term treasuries. And when I say a leading indicator, that means that it basically predicts, if you will, kind of looking at this graph here, the Fed funds is in the green, and the 2-year Treasury. When the 2-year Treasury goes up, the federal funds rate is typically not too far behind. So as we are here in September 24, the 2-year Treasury rate has dropped considerably, hovering now at that 3.6 mark, and then we're actually, this is a little bit slow, so this would be as of 9:30, and the Fed did drop 50 basis points, so we would probably be right about here, about the 4.5% mark. So so now we're kind of getting into where the Fed is moving going forward. A month ago, we had somewhat of an expectation of the Fed potentially moving rates by 6 months from today and being somewhere in the market of between 2.5% and 4% or 4.25%, because we were still trying to figure out exactly how much we were going to be dropping these rates. And you can see that prior to the September meeting, this is exactly where we were. This is the range that probabilities had interest rates being. So 2.25% to 2.75% range, all the way up here to 4.25% to 4.5% range. And we've really kind of honed in here. The markets attempted to persuade the Fed into strong rate cuts, and it went somewhat unnoticed. And the Fed is really ranged in their scope, kind of relying on some of the most recent supportive data. And they appear just to be a bit more sort of hawkish in terms of their path forward, kind of zeroing in 6 months from today, May 7th of 2025. This is the smaller range where we see ourselves being in terms of the federal effective rate range. And this is actually one of my favorite graphs here, just because it kind of speaks to the longer term sentiment. And this meeting where we cut 50 basis points did mark a point in history where it was kind of a turning of the page into the next sort of era, if you will, of interest rate policy. And so each one of these dots really represents a vote of a member of the Federal Open Market Committee in terms of where they see interest rates being. The blue is really the mean, sort of the average, where this is typically where that yield will fall at that point in the future, given everybody's sentiment on the committee. So you can see that there's this slow, gradual kind of dip, and then a bit of a bump up as well here, kind of at the end, but really settling in around that 2.5, 2.75% range for the federal effective rate, which is where it's a happy place for the economy. They feel that the economy can grow without constraining it too much, and so we feel that we could probably be arriving at that point, somewhere maybe early 2026 right now, but Definitely by mid 2026, I'd say. And this is just another iteration of how we can kind of view those predictions. So over here, where we were, a couple weeks ago, 5.25 to 5.5%, it's off the map because we're looking downward. Um, on the left-hand side, you can see that there's the future meeting dates of the Fed. The next meeting date is on November 7th, 2024. And in the blue is basically the highest probability of where we see those interest rates being at that point in time, or where they will decide to move those interest rates. So you can see that conceivably, by October 2025, we could be, between 3.25 and 3.5%. And this is really what you can liken to like money market rates. So LGIP rates. And I always like to think that you're going to be kind of more near the downside here. So 3.25 to 3.35% if we fall within this range. And that's sort of where we see interest rates going. And so I would pause here for questions. Um, but what we're going to do, I think, is just kind of move forward and kind of talk a little bit about, you know now we know where the Fed is going, and we know, what the tools that the Fed is using in order to sort of help them through here, um, the data that they're relying on. But what's still available in the market, and what can we do as a school district in Wisconsin? um, and I'd be remiss if I began this discussion without talking about some of the tenets of investing in, state statute allowable investments in the state of Wisconsin, which promote, first and foremost, safety of principal, making sure that your money is protected. That's paramount. These are tax dollars. Obviously, we can't be playing around with them. Liquidity is, second. It should be a focus of the districts, obviously, to have money when they need in order to fund their liabilities. And then third, but also important, is yield. And so making sure that you can make money where you can, when you can. And here are, again, the state statute allowable investments in the state of Wisconsin. So treasuries, government agencies, we have CDs, bank product, and then local government investment pools. And then you kind of get into, this other sort of miscellaneous group where there's muni bonds, repurchase agreements, and commercial paper. And that commercial paper is kind of, that's where we were talking about Boeing earlier. That's that corporate debt that doesn't necessarily have the backing of the taxpayer dollars, because people are going to pay their taxes. What it does have the backing of, and it's a little bit more riskier, but it's still safe enough to be state statute allowable given its rating, is these corporate debts. And so we don't offer commercial paper to individual investors outside of the SMA space, or the separately managed account space, but there is the yield there, where it's beneficial to utilize it within our pools, really just to diversify that risk amongst all of the participants. If ever you're curious about it, all of these portfolio allocations are available on a semi-annual basis via the WISC rating reports. WISC is triple AM rated through S&P, which is the highest liquid asset fund rating that they offer. So if you're curious, some good reading there. And so this is the forward curve. And so really where we've been, so a year ago today, we were in the gray, really high liquid rates, really kind of bottoming out around the 5-year mark, and then kind of going upward from there. But you were getting, 5.5, 5.6%, somewhere around 6 months to a year. Where we were, just a couple months ago, still able to find that 5.25, perhaps, within 3 to 6 months, certainly. And then here we are this month, or shortly after the meeting, and you can see that the forward part, or the short-term part of the curve has dropped considerably. And a year from today, we expect it to be very flat. So still doesn't really pay much to invest too far out the curve, but liquid rates are still going to be, competitive versus, historical yields. Certainly not recent history, but we're definitely seeing a normalizing of the yield curve here. A normal yield curve is going to begin somewhere down here, I'd say, maybe in this at this level around the 2.5%, and it's going to sort of angle upward and then level off as you kind of go down out towards 15, 20, and 30-year bonds. And then this is really what's available in the market here today. So this is not a comparison of liquid yields and fixed rate yields. What this really is just an indication of where Fed futures is at this point in time and what some of the indicative rates are that we're seeing out in the market for different terms. So 6, 12, 18, 24, 30, and 36 months, you're really only probably going to see, these 2.5, 3-year yields in like a fund 46 or fund 41 or something when you got plenty of time. But really, it's just meant to communicate to you, let's say you want to look out for a 2-year treasury. You can get a 2-year treasury right now to like a 378. And at maturity, Fed futures project to be about 66 basis points below this yield, this fixed rate yield. So the idea that yields are going to continue to drop and you could lock in sort of at a yield perhaps 66 basis points above where that might be at maturity, just kind of speaks to the fact that you should be out right now talking with whoever it is that you guys kind of shop these things around, your local bank, whoever, just kind of seeing what's available to you. Because if you have the opportunity to invest out, it's certainly worth the discussion. Take a look at the opportunity that you guys have in front of you. We have here some liquid yields. The 4.81 is where WISC IS was as of yesterday. Still very competitive, versus historical rates. But again, it's going to be changing, and so I would say that probably within about 7 to 30 days typically is where the duration of these portfolios sits, these money markets. So what that really means is that between 7 and 30 days after the Fed meets or makes a decision on interest rates, these portfolios are going to turn over. They're going to mature and be reinvested in things that are yielding a lower yield. And so what that means is that very quickly after a decision, your money market rates are going to be dropping. And so fixed rates, I'm sorry, are going to be dropping as well, at probably a bit more of an unpredictable rate, but there is still opportunity out there. So be happy to help if we could. And that would be the conclusion of the slides that I have here today. So John, anything else that you think I missed?
No, it's really helpful, and I think one of our frequent listeners asked about the 4.81 for the WISC, and that's a good rate. Solid.
Yeah, it's a bit different than what you might find somewhere else. So the 4.81 is actually going to adjust on a daily basis. Other money market yields within the state of Wisconsin might show like a 30-day average looking backward. So it's really just important to know sort of what you're looking at in terms of comparing shopping around yields, just understanding the difference in terms of how those are calculated and when they're calculated. So
Yeah. One of the other questions we had earlier today was about the Fed meetings, and the question had to do with whether the Fed can change the rate at any one of the meetings. And
yep.
probably your answer was yes.
Yep. Yes, they absolutely can. In fact, they can actually also call special meetings in order to move rates if they feel that it's important enough to do so prior to the next meeting date. And so I believe we saw that when they dropped rates back in, was it late 2019, early 2020, I think. If I remember correctly, it's all kind of a blur. So sometime around that point in time.
So Matt, looking at this chart, if I was a superintendent or a business manager, I could call you and I could say, "Hey Matt, I want to do some cash flow analysis. I want to look at when we're getting money from the state, when we're getting our tax levies in, and we want to talk with you about how to invest those." We could do that, and you could tell us like how much you might have at different points in time and what you might recommend in terms of how to invest those and what they're going to get out of the deal.
Yeah, absolutely. So that's one of the biggest pieces of this new cash flow tool that we have. So what we do is we map out the revenues and expenses for these districts, and we're able to pull out dollar amounts on funding dates, saying, all right, you've told us that throughout the entire fiscal year, you want to have a minimum of at least $500,000. Typically, it's like 2 or 3 payroll cycles that people want to have minimum at all points in time, which is that's a good number. And everything else above that, what we can do is say, all right, well, on this funding date, we know that you can invest, you know, $1.2 million out to these 6 maturities, and then we'll go ahead and bid out all of those 6 maturities across our entire network and securities dealers, and then we'll show all of that information to the district. Our job really is just to provide the information and maybe provide some recommendations, but by no means does anybody need to take the recommendations. It's really most important that they have all of the necessary information in front of them for them to be able to make the best decision that's right for them. So
Well, and I love sharing the story that how we worked with you when we were doing our construction project, and really helped us make up a difference between what we had approved in our referendum versus what the cost of the project was. That was good good news to have PMA in our team. So, well, this is helpful, Matt. I think it would be fun to have you back to talk about this new cash flow analysis tool. I think it would be useful for folks out there, and we'll get that on the schedule sometime before Christmas. And appreciate the opportunity.
absolutely. Thanks again for having me, John. Twice today.
Yeah, exactly. All right, I'm going to pause this.